Portfolio Builder members, today we've hit another profitable day by predicting that we would have a down move in the S&P 500 by Friday. And so if we review the trade we have open, we sold the 278 call option, which is called a covered call. It's the easiest option strategy there is. And we're doing it against the safest equity on the planet, which is the SPY ETF. And that's because it represents 500 American companies. And the biggest position in the SPY ETF is less than 5% with Microsoft. And so as you can see, when we first put on the trade, we were able to collect $3.13 of option premium. Today we can buy it back for $2.75 at the moment. And this was a move to protect our capital and to potentially generate profit on the option contract, losing value at a faster rate than the depreciation of our underlying asset, which is the SPY ETF. So bottom line is that we did generate a profit over this period of time and are going to repeat the same concept by covering that position with the buy to close and then opening up the position. So we're rolling over the covered call and we're going to sell, and I haven't picked the exact prices yet or screenshotted this, but right now you can see what we're trading at as the market has opened. So it'll be something like this. And we also have a similar trade on the what we call poor man's income strategy, which is trading the TBT ETF. Now the TBT ETF goes up when the 20-year Treasury yield rate goes up. And so this is a relatively stable rate that our strategy attempts to predict the directional move and write a covered call to create the profits. So far this portfolio is up 7.9, trading the TBT exclusively, whereas our SPY strategy during the same period is up 6.3. The big difference is the SPY strategy, we do a rolling covered call every Monday, Wednesday, Friday, whereas the TBT doesn't have the 3 option expirations. They only have 1 per week, and so that's why we only need to trade this position on Friday. Now you can get started on any day of the week, but Friday is the best day to roll over the position. The current option covered call we have written, we collected 18 cents. We'll be able to close that position today for a penny. The new trade, which I haven't picked just yet, right now we're just reviewing all the content, will be somewhere around the $34.50 strike price. So in this video I will show you how to insert the trade into the spreadsheet, as well as how to execute the exact trade and what's going on in my thought process in terms of how we're picking our strike price. And before we get to the exact trade alert, I want to cover today's content that's important relative to the trading decisions we're making today. So the big fear is that retail and hedge fund investors are not buying this rally, which has been of epic proportion. Instead, it's been central banks and corporations, who you might call zombie buyers. They don't really care about a return. They more care about keeping their credit alive so they can keep borrowing. And so while the central banks, such as Japan and China, may still help a bullish outcome for March, the corporations who've been buying back the S&P 500 in record pace in 2019 are entering a blackout period. And at the same time, we have an oddball expiration period in the options market that historically has led to a sell-off after the close. So after this Friday, there may be the potential for a run-up into the close and a dump for the next 2 weeks into March. Now, overall, the 2 key factors I watch to determine whether we need to go completely bearish or can remain in a bullish stance in the long run, we're talking about after this volatility spike in March, is 1, keeping track of the dollar index, which is remaining strong. I like to look at the Korea stock price index as a leading indicator, which is pointing back up. And most importantly, we're looking at the yield rate on treasuries, which are absurdly low right now. And finally, the dollar against the yuan. So with China on a printing binge, it's looking like stocks must go higher till these rates go up. Now here's a quick slideshow I've put together. Crash warning, beware the Ides of March. And after this we'll get into finalizing today's trade alerts. So we have a lot of things happening at once. Surprise index is going slightly negative for the rest of the month. We have an extreme run up in gamma, which is likely to be sold off at this level. This is the new levels of price, which would create either a buy or a sell from Charlie McElligott. So for the next few days, the number is 279. If we go below that, that could cause other automated trading strategies to begin to sell. So that's what we're looking at in the next few days. Early next week, that level jumps to 278. And as we get towards the end of the month, that level drops much lower. So after the end of March, we may be at a great buy the dip opportunity and look for another bull rally. And so this is the chart puzzling everyone. Typically, the 10-year yield is overlaid very closely and correlated to the NASDAQ. This week there was a presentation from Jeffrey Gundlach, who I follow very closely, every single thing that comes out. And he's very bearish right now. Essentially does not think that China and America can come to a significant trade deal. And essentially his main prediction is that we will get a crash below the December low. And as far as timing, without some very dovish news from the central bank in terms of further lowering rates or starting up QE, that the stock market will have another plunge. He's actually predicting in the next 3 to 6 months, and that the central banks will react to it and begin the next round of quantitative easing. So here's his first chart looking at the central bank balance sheets, which is rising again. They tried to drop it in 2018, and we had a bear market in almost every asset class around the world. The global economic momentum heat map, as you can see, has gone to red from being totally green in 2017. So also it kind of reminds me of 2015, but much worse. 2015 was a bumpy year for the markets, and especially for China. So we can go to the next step. He really likes to look at sentiment indicators for trying to predict recessions. So we can see the economic data change has turned negative. But this is alongside a very tight jobs market. And the reason he looks at this as a negative is that he believes it will continue to push wages higher, which will eventually create rising prices and force the central banks to eventually start raising rates. And so in this chart, we can look at a 12-month lead. The blue line has been extremely accurate, and this would indicate that there is a continued upward pressure on wages. And the U.S. Conference Board consumer confidence had a big spike after starting to crash and seems to be very related to short-term moves in the stock market. But as you can see, this has really collapsed leading into recessions and acts as a very good warning sign of when we may enter a real recession. This chart shows that people are very happy right now with where they're at, but their expectations of the future are very negative, and this has tended to indicate a recession looming, not immediately, but looming. This is one of the first really bad prints for economic data with the U.S. retail sales showing a negative 1.6 print, similar towards the end of 2008. And as you can see, leading into 2008, there were some prints around this level. So just one of them is not a big deal, but if this was to continue repeating, that'd be a very good indicator that we're heading towards trouble. And this is what keeps Gunlack up at night. He hates debt, and he believes this is the big picture. This is the one thing you need to understand to survive the next crisis, and that it will be surrounding not anywhere else, but surrounding the U.S. debt crisis. And so the main thing he's upset about is the federal government's spending going exponentially up. You can see the purple line for the home mortgage sector has pretty much been flat over the last decade. And then the corporate debt is also just skyrocketing up. And so the analogy he gives is that we've shown all this growth in the U.S., except that it was done on credit, not with actually our own money. And so this gets into some pretty complex stuff about, what exactly money is, when do we create new money, and what's the best way to put it into the economy. But his concern is that he does think we'll have rising interest rates, which will collapse both the corporate bond market and the U.S. Treasury market. And we won't get into too many details on that today. The CBO is projecting that the percentage of GDP is going to start really escalating up towards a higher and higher interest cost, which will become more and more a burden on the American people. This is a model that says stocks are overvalued, but it's all relative to interest rates. With low interest rates, you can expect to make a profit borrowing from the banks cheap, but if interest rates rise. So the big thing that everyone's watching is, why hasn't Japan had inflation and been forced to go from their negative rates? And they are the biggest abuser of this so-called debt bubble. Here's a quick look at companies that we get to enjoy, a lot of them at least, from the SPY ETF 2019. This is what happens in an internet minute, and you can see it's well divvied up between all these different brand names, from Instagram to Twitter to YouTube to Facebook, Google, Netflix. They are growing very rapidly, and by owning the SPY ETF, we have a piece of all of these. This is a look at the Chinese credit system. They put a ton of money in to the markets in January, but it ended up being less than everyone expected. And now we're getting mixed rhetoric from their finance ministry as to how they're going to deal with some very big problems in China. And mainly it's that their biggest cities are doing extremely well, exporting goods and services, and there's others, less developed areas which host huge amounts of people, are doing poorly. So they're having to take profits out of their strong sectors and support their weaker sectors. And so they're doing this just by simply printing money, which is why we're carefully watching the conversion rate of the dollar to the yuan. So right now all the data from China is turning negative, which is explaining why they are printing so much money. Their stock market has been going wild. This Chi Next stock has been well tracked, just going straight up in March, and then started to crash as they talked about not providing liquidity, or perhaps they're just trying to cool off their market. It got a 9% crash in 2 days. And you can see the green line represents the credit line increasing, and then the red is this Chi Next price index rising right alongside of it. We can see that the world trade is tumbling right now, but certainly we do know why. And so once again, the fate of the world lies on this Chinese trade deal and what they decide to do with dealing with their own internal problems. Will they let their GDP slow down and face a potential credit crisis and market crisis, or will they keep recycling their debt and supporting their parts of their economy that are unprofitable. You can also see a stump in new home sale prices in this chart. And now the odds that the January 2020 rate will be cut instead of raised up to 35%. Okay, so let's take a look at our final trade alert. For those of you following the SPY program, we're going to buy to close the March 15, 2019 278 call for 265. You can use a market order. This is a highly liquid market and you will get a good price. So we made around 60 cents per contract profit, and in our portfolio that's 1,700 shares. The new trade is to sell to open 17 contracts. That's because we have 1,700 shares of the SPY ETF expiring March 18th, that's this Monday, at the 275 strike, which is below the current trading price. So if it jumps up today, we may be assigned for a break even on Monday, and we'll be back into cash, which we're perfectly okay with because we are expecting a potential drop in the price of the SPY between now and the close of Monday. So if that is the case, we will open the same trade or a similar trade with a strike price well below the trading price. And if we do see the weakness we're expecting, look for some VIX call options and QQQ put options next week. I don't like to begin shorting until we actually see the weakness, but doing this risk-free play on the covered call is an easy way to protect our capital and keep the consistent retirement income coming in. Okay, so this is the 35.50 strike from last Friday. We made a 99% profit on it. You can buy that back for a penny. Our underlying asset did go down in value slightly, but not as much as we've made in the long run of just doing this trade over and over again. Today we're going slightly below the trading price with our new sell to open. This is on 1,000 shares of the TBT. Expiration is next Friday, March 22, at the strike of 34.50, and again that is slightly below the current price. So if the TBT were to jump higher, we may again be assigned, and in this case we'd actually generate a guaranteed profit, which of course we're happy with. If the TBT drifts a little lower, which may happen if the SPY ETF drifts lower next week, this will protect our position and also generate profits. So let's see how we would put this into the portfolio builder platform now. So first we'll look at the rich man income strategy, which again, this is starting with a $500,000 portfolio. So far it's up $33,826, starting around, let's see, December 10th. And so we've primarily been selling covered calls, either above the trading price if we were bullish or below the trading price if we're bearish to accomplish this. So we launched this right in the middle of the Christmas massacre and have walked away with a healthy profit and very little drawdown. And again, our strategy is not to make the most money, it's to make consistent retirement money and protect our capital. So we're not trying to outperform anyone. We're really trying to reduce risk and generate profits. So as you can see, this is the trade we need to close out. For most of you, you'll want to just scroll to the bottom and plop your trade at the bottom. In this portfolio, I've been having the habit of carrying these trades down lower so that it's easy for you guys to view when you come to the page. So if you want to see how to do that, you can just highlight. Now some of you may try to follow the alerts without the Excel sheet. That's fine. I've made this basic program so easy to follow that you could do it from your phone. We really like the Robinhood phone app. They're private equity investors over in Silicon Valley, pay for all commission costs. There's absolutely no commission cost. There's no catch. It's just a very, very good deal. So now I'm going to move this down. We covered the position. There was a call option. We sold 17 contracts. Now a lot of this I can leave up here because the trade will be repeated Here's the option start price. Now, we were able to buy it back today for $265. Now, you may get a different price, that's fine. So, we generated a 15% profit on the covered call. And now the rest of this I can paste directly below. So, this part right here, control copy, paste. If you use Robinhood app, there are no commissions. If you use Interactive Brokers, Thinkorswim, or some popular, there's a lot of good platforms out there and a lot of competition, so I'm sure you'll get a decent price. Okay, now this is always going to just push over there. This one I can click on Monday. The price I know is $275, and the new credits we're receiving today. And again, we're not going to keep all of that. We're not expecting to. But this protects us for $5 lower on the S&P 500 from the current price. Actually, $5.50 lower. And we can generate the option premium if it trades in that range between $275 and the current price from now and Monday at the close. So that's it. We brought in a very large credit, but that's misleading. Now, if you want to track the real-time price instead of in your broker, not that it's really that hard, but if you put the contract, which is in the trade alert, in your email, you can paste that in, and now it'll look up the real-time price. Now, it is delayed, and sometimes Yahoo Finance is buggy, but it will eventually pull that data right here. Okay, so that wraps up the SPY trade. Very easy. And again, the profit looks a little inflated. That will drop back down once we cover the position and then open a new position. So it's going to look like this inflated return for the next 2 weeks while I remain cautious and continue to write the strike price lower and lower. We do have some open call hedges open, and they're tiny. These were less than 1% positions. And if we do see some weakness at the close today or into early next week, that's when I intend to close all 4 of these and open one large 10% in the money VIX position and a 1% out of the money put option on the QQQ. And so rather than having all these little trades, it'll be very easy to understand that we need to maintain 10% exposure on the in the money VIX and a 1% exposure on the Q. And I will help with the exact strike price and the exact expiration date to help capture the biggest potential profit from a downside move. So these trades are highly risky if anytime you go long an option. That's why most people who've been in the game a while know that writing options is the consistent moneymaker. So we're playing it safe in 2 ways. We're writing the strike below the trading price and have the potential for small, consistent gains doing this during a bear market. But to capture big gains and add a few points right here safely, a reasonable hedge will be a deep in the money 10% VIX position, which won't lose its value very quickly if we're wrong, meaning that if we don't see weakness after entering the position, we can exit without a huge loss. And then the out of the money QQQ, once we put that on, it will either immediately start generating a nice profit if we are heading lower, or it is going to lose value quickly. So that will be limited to a 1% position on that. Okay, so now moving to the TBT. The 20-year yield is not going to be flying around very much unless the central bank continues to manipulate it. And they've already dropped it considerably lower, about from 3 down to, let's see, right now, the last print was 2.86, which is very low. And if it goes too low, there will be no interest from foreign investors because they have to worry about their own currency depreciating against the strong dollar. So they have to hedge against currency risk while buying our bonds. And so if that yield goes too low, we're not going to be able to fund this massive deficit that the U.S. government wants to continue and has really no line of sight of stopping. So it's highly doubtful that this rate will go lower. And in fact, Jeffrey Gundlach is predicting this will go to 6 or higher. He thinks it will overshoot and much sooner than most people predict, which means the underlying TBT asset, let's pull that chart up. Means this thing's going to likely $140, which seems insane. But once we zoom out and see how much this thing has crashed, you can see it started off at 290, and it's just been a horrendous crash. And that's because we've been in a loosening of interest rates. So at the end of the day, we do believe this has a very strong bottom price, and that we can consistently write the covered call, generate the income, and enjoy a slow but steady rise, likely to the $40 to $50 range before it might really point to some trouble in the U.S. equities markets. So following the TBT does help us understand when we might run into trouble in our SPY trade. Okay, so let's move our TBT trade over. This one I've been doing the other way. I've just been lazy and plopping it right down here. So I will put that first trade there. The credit we took in was 18 cents, which is a very nice yield. That's because it's a double inverse ETF. That's how we're getting that really nice yield. Whereas if you were to do this on the TLT and predict it was perhaps going down, you would not get the same, nowhere near. You get like 1/4 the yield. So this interesting ETF demands a very high yield from the covered call, which is why I like it. And this is when volatility index, which is MOVE, if you want to follow that, I'll pull it up. This is the move volatility index, and really what it means is the higher this goes, the better the yield will be for our TBT position. Right now it's at all-time lows, or yeah, record lows. And we're still getting a fantastic yield, and surprisingly we've had no liquidity issues. It seems as though all the automated trading programs out there from the big banks does pick up our trades. They figure out how to correlate almost a guaranteed win, and they have been very happy to buy our call options that we're writing. So the credit today at the mid price was 45 cents, but this had a pretty large spread between 40 and 50, and the last trading price as of this quote was 69 cents. So you could try going for a bigger credit, give it 30 minutes. If you don't get filled, try lowering it. I'm going to put 45 right at the middle. And so now this portfolio is set for the next week. There will be no action for this guy until next Friday, and that will be simply to cover the position and open it back up. So this one jumps back into the lead with a 9.4% return after entering today's, but it did actually take a guaranteed loss on the underlying. So that, I expect that ROI to be slightly less by next Friday, but still up from prior to entering this trade. And we'll grab the new code and put it right there. And that's that. So I look forward to speaking to you guys on the webinar. If you have any questions or you just want to chit chat, I'll have this open until 1 p.m. Eastern every day immediately after the video trade alert. So thanks again for your time, and look for a new trade alert